Welcome to December, which in the finance world means economists and finance gurus get out their crystal balls to let us know what they think is in store for 2018. Before we dive into current forecasts, I thought we'd have a quick look back over some recent history and see how forecasts of the past have turned out. From December 2016, the headline read, "Why the Trump-inspired rally in US stocks is fragile." It went on to say, and hence we have reduced our net exposure to the US market to single digits. How did that pan out? Well, the US share market is up 23% in the past 12 months. So if that's fragile, please let me know where I can get more fragility, because that sounds like the kind of investment that I'd like to partake in. From March 2017, and a leading fund manager has just the ticket for retirees contemplating how to make the most of their retirement savings at a time of record low interest rates. Their new product, the Income Maximizer, is a real win for those wanting reliable, high sources of income. How did that turn out? That fund is down 2% for its first 6 months. Meanwhile, an investment in the ASX 200, or the All Ordinaries, is up by 6% for the same period. That's a massive difference of 8% for just 6 months. They sure were right about it being a high source of income, but sadly not for investors who ploughed their money into it. It sounds like a high source of income for the investment manager making those investments. Going back a little bit further to July 2013, and a leading fund manager came out and said the resources sector is going to do it very tough over the coming years. BlueScope, Australia's leading steel manufacturer, at that time was trading at $4.91. Today, the price of BlueScope is over $13 per share. Now, I'm not sure what tough means, but an increase of over 160% in 4 years sounds like a tough investment to miss out on. Fortunately, we didn't follow any of those forecasts. Investing isn't easy. There's lots of noise around and it's really hard to separate fact from opinion. So by all means, read financial papers and journals, listen to the news, listen to the radio, but just pause for a moment before you take action based on what's being read or written. So what's Aligned Financial's view? Well, we remain invested in Australian shares because we're attracted to the dividends. We remain invested in global developed companies for the prospect of continued capital growth. We remain invested in emerging markets for the prospect of rising economic prosperity, which will lead to new markets for companies to trade in. And we remain underweight Australian cash and term deposits because current rates are just lower than what most of our clients say are acceptable, and interest rates don't look like changing any time soon. Here at Aligned Financial, we'd like to wish you all a Merry Christmas and a Happy New Year. And I hope you get the chance to slow down, look around and take in the sights and sounds that tend to pass us by so quickly. Being slow and present is the one thing that I'm focusing on over the next month, and I invite you to join in with me in doing this. Merry Christmas and bye for now. P.S. For those of you who are going to email me and ask me what my forecasts are, they're on the screen now. All the best.